I made a post saying that not all revenue leads to value. I got a lot of heat from it, right? Like, how could it possibly be that if you grow revenue and you grow your sales, that you're somehow not creating value? You may have to realize that adding more logos may not necessarily create value because those small customers are taking away time from your larger customers. That's always something to keep in mind, right? Am I spending the time on the most profitable customers? And if the answer is no, then you have to rethink your strategy. And so the more sustainable revenue can be, the more valuable it is to a buyer. How would a buyer look at my business? And you can do that through valuation, and then do it again next year and the year after that. And you can now really see, are the actions that I'm taking creating value?
Hello, everyone. Welcome to another episode of This Is M&A. My next guest is a managing director at Objective Investment Banking and Valuations, where he helps funds, startups, and corporates understand their business worth. With over 15 years in financial modeling and valuation experience, he's guided clients through everything from tax and financial reporting to estate planning, strategic appraisals, and M&A decision-making. Before joining Objective, he spent nearly a decade at EY in their corporate finance practice, advising technology, healthcare companies on transactions and valuations. He was also honored by the M&A Advisor as part of the 16th Annual Emerging Leaders Award, recognizing his professional achievements in leadership. He also served on the leadership board of ACG 101 and the Exit Planning Institute in the LA chapter. Outside of work, he's passionate about fitness. I'm going to ask you, Jordi, does that mean we're going to find you at Venice Beach squatting spreadsheets?
Yeah, I always say that modeling, becoming really good at modeling is my goal, but not from a fitness standpoint, from a financial modeling standpoint. So it'll be a few years before I ever make it down to Venice Beach and Muscle Beach.
Perfect. Well, hopefully I'll get to see you out there. Well, it's a pleasure to have you on the show, Jordi. Obviously, we're going to jump into some really interesting topics here. Happy to have you. We're going to dive into questions that every founder and CEO wrestles with, right? And it's building revenue. Is it the same thing as building value, right? Spoiler alert, it's not. It isn't, right? But we'll unpack that here. There's 4 big themes that we're going to unpack here in a moment. 1, what really drives the valuation beyond just the top line growth. Number 2, what buyers are actually looking for and how to course correct sales strategy. Number 3, the diligence landmines that can derail a deal. And then lastly, if we get to it, hopefully we'll have time, typically try to keep it to about 3 bullet points. But the 4th is using valuation as a KPI to steer growth and get exit ready. So with all that being said, Jordi, I mean, where on earth do we get started here? What should we unpack first? I'll let you, the show is yours.
So it's funny that you mentioned about revenue, because I made a post saying that not all revenue leads to value. And I got a lot of heat from it, right? Like, how could it possibly be that if you grow revenue and you grow your sales, that you're somehow not creating value? And at different stages of different companies, growing revenue may be the goal, right? Especially if you're trying to get the word out, if you're trying to create network effects. If, for example, a lot of your marketing is going to come from word of mouth, you may be buying that revenue. What do I mean by buying revenue? I mean that you're spending more than you're getting back from that customer. So you're putting customer acquisition out there, you're not getting the value back in the short term. And so additional revenue isn't necessarily leading to cash flow. So that's kind of like the obvious one, right? And when companies start investing. However, there comes other points where adding more revenue, again, may not necessarily lead to cash flow because your unit economics may be off, or your indirect expenses may also be hindering your potential. So you may be growing a business, but you're actually not growing the bottom line. And so I just want to make sure that people understand that just growing the top line is not how you create value.
That makes a lot of sense. And actually, the current market landscape, it's shifted a bit more than ever in terms of what investors and acquirers are actually looking for in terms of how to build value. It isn't just go scale and grow and burn cash at all costs. It's okay. That model shifted a little bit, right? Now it's geared around, to your point, cash flow. It's EBITDA positive, and it's also operational excellence. I've seen that come into play a lot more now, right? Is these PE firms, they want companies that they know It's not dependent on the CEO of who they're acquiring. So it's something I've seen actually in the data room space, and I've heard in several of these conversations. By all means. So when it comes to revenue versus value, if you're a CEO, how do you distinguish where you're at in that stage where as a company, does it make sense? Should I be focused purely on revenue? Should I be focused on EBITDA? What should I be focused on and when? Maybe if there's some guidance you can give around that a bit.
Sure. So I think every story has different stages, right? So like we talked about in the earlier stages, it may be okay to overinvest to gain customers, to try your product, to get feedback for a product, and to spend a little bit more than you're making. Now, like you said, the tides have shifted in the sense that people are looking more at unit economics. So if at least I'm profitable at a unit economic standpoint, right? COGS to revenue kind of ratios, then I'm probably going to be okay. I can work through the indirect expenses. But if I'm already off at my unit economics, every single customer that I add, I'm losing money on. And I haven't even, touched my G&A and everything else that comes into play. So that's one, thinking about unit economics a little bit earlier on. And the keyword I think that everybody should remember is sustainability, right? So if you're adding more customers, how you're adding them, is that sustainable? And if it is, you're kind of on the right track. If it isn't, and you're still kind of burning the midnight oil consistently, then it may not necessarily be the best revenue. And I'll give you an example. So, large companies do this too in very mature stages where they'll saturate, for example, the Fortune 100, the Fortune 500, big corporates. And because their salespeople need to continue to be incentivized, they may be incentivized on, let's say, new logos. So they may be adding a bunch of SMBs, making sure that they're putting new logos on their commission book. And that may be okay, but you may have to realize that adding more logos may not necessarily create value because those small customers are taking away time from your larger customers. So you could be, for example, servicing those customers better. You could be upselling those customers. And because you're spending time on all these smaller kind of players, you may be hurting your bottom line. So that's always something to keep in mind, right? Am I spending the time on the most profitable customers? And if the answer is no, then you have to rethink your strategy.
Yeah, I definitely agree with that. Sometimes it pays to say no. That there are those customers where they could suck you dry of all your time, and it could be the smallest one and not the most strategic account. Sometimes they take up just as much time. On the flip side, there's also, you don't want to be customer concentrated where you only have two big customers, and that's what's driving all of your revenue, right? So there's kind of the adverse side of it, which is you got to just make sure you have a healthy balance, a healthy mix.
Completely agree. I think the equation is always risk versus future cash flows. And you touched upon one point that's really important, right? When buyers see customer concentration, they see that as a really risky proposition. So if one of those customers leaves, suddenly I'll lose 35% of my revenue. That's not a good position to be in when I'm buying a new company. And I know that the transition is going to bring some turmoil in terms of culture or contracts or anything else, right? So as a founder, as an entrepreneur, as somebody running a business, that's something to think about, right? Take a step back, try to analyze your customers and try to understand, where's my value coming from? Am I over indexed on large customers? Am I over indexed on the customers that are taking too much time? Where is that right balance?
That makes a lot of sense. And, to your point, all revenue is not good revenue. If you got to pay 3x to get it, right? Your CAC cost is through the roof. And you don't show a plan that says, no, we know how to drive that down, and you have some proof points to it. That becomes a lot less attractive than you have a plan that actually says, and some proof points, hey, we know how to drive this CAC cost down so that we can make this revenue profitable, right? So
that's exactly right. Never overdo it to a point where now you're really risking the company because your cash flow is not sustainable and you can't align the next investor who can get you through that stage, right? At some point, you have to become sustainable. You have to become profitable. It's just the way it is as companies mature.
So just reflecting back to your experience and the types of transactions you've worked on, do you have an example? And obviously, I know the stuff we do, it's very confidential. It is in the data room space as well. So we don't need names, but where there was strong revenue growth and it actually hurt the company. And did you give them some sort of tips, tricks like, hey, let's come back when you've done this? Or maybe it exploded a deal. Do you have any examples of that you can think of?
No, the one that I was talking was a very real example. So we had a very large acquisition of a hardware kind of software player entering the software space with a very aggressive strategy and purchasing that company that the first thing they did was split it into two. So what were the corporate customers and what were the retail customers? And the first thing they said is, yes, we're going to buy this company, but we don't want all your retail customers. You can spin that out. You can create a new company. You can keep it. We don't want it. So already there, they're saving from perhaps a less profitable customer base, which is a retail customer, right? They're kind of one-off customers. They don't all return. They're harder to track. You're dealing with a lot of data. So it's a difficult business. Plus, they were in the business of serving corporates. And so that was something that they needed to do. And the second thing they did was segment their customers, right? So how are we going to service the top 10 most profitable customers? Not the biggest revenue, but the most profitable customers. And then the next 100, and then the tail end, right? And so they broke the tail into the top 1,000, the top 5,000, the top 1,000, not that they got fired, but pretty much got fired because they weren't bringing in a lot of profit, right? It was a lot of time and effort that they could take away from the sales force and actually eliminate a lot of those positions so that they didn't have to serve those customers. Today, it could have been easier, right? They could have used AI, but I guess at that point in time, all they could do was really kind of like automated chatbots and maybe get some servicing outsourced. And then that second kind of set of customers, which were the bigger customers, again, your top 10, make sure that they have good touch points, make sure that they're getting service, make sure that they're getting cross-sold and upsold. And then your next 100, again, good touch points, making sure that you can grow those accounts, making sure they know your services, but investing in those customers that could also become highly profitable customers. And it was a real strategy. And it's the one they followed across 3 more acquisitions. And it served them really well because they've created a lot of value by kind of trimming some of those more unprofitable tail ends and highly time-sucking segments of the market.
Right. And oftentimes we're always working in a resource-constrained environment. So some of that trimming probably helped out significantly. So it can focus in the right spot by all means.
Yeah, and investors were scared, right? There, when you hear that someone's going to buy $10 billion worth of revenue and it's going to throw away 2, it's scary, right? When you realize that all you lost was maybe 1% in profit and that next year is going to be even better in terms of profit, then they start realizing that, oh, maybe it was the right.
Right. So I'm going to talk a bit about the comment you made earlier about your LinkedIn post. I'm going to revisit that for a second here. You got some pushback on it, right? And understandable because this is a conversation that really needs to happen in order for them to understand what that means. And it's hard to get that across via LinkedIn sometimes. But how do you address, because I imagine you're going to get that pushback when you're talking to a founder, an entrepreneur, a C-level exec, a CEO, and you're telling them, hey, not all revenue is created equal, right? And oftentimes when I look at an investment banker, an advisor, I look at them to not be my yes man. I want them to tell me no. So I appreciate that, but others don't, right? I actually look to associate with folks like that. And that's kind of your role in this is you're not there to just say yes to everything. You have to challenge them and challenge the business model and challenge the business to understand how to best position them for market, right? That's kind of into how to build the value. So I guess in a long-winded way of asking the question, how do you explain that to a founder? How do you tell them, hey, not all revenue is created equal? And how does the emotions behind that, maybe if you could speak to how some of those conversations have gone in the past?
Sure. So you've probably heard of normalizing EBITDA, right? And if you tell a founder, well, we're going to normalize your EBITDA for that one-time cost that you incurred last year when the roof broke at your manufacturing facility, because it's not coming back, right? Next year, we're not going to see that. So your EBITDA should be adjusted upwards. You should have more EBITDA. You didn't have that expense. You also have to tell them, well, this one-time revenue is not coming back next year. So we can't include it either, right? So you start with, here are the benefits of some of the normalizations that you're going to see during diligence. And here's the disbenefit from some of the normalizations that they're going to require from us as well, right? Like you have to be true to both sides, and doing that sell side diligence is really important to uncover those things. That's why that extra customer that you squished in last minute with a bunch of discounts, if they're not really coming back, right? If the only reason that they came to you was because you undercut your competitor, they're unlikely to repeat if you can't hold that pricing. And if they weren't profitable, you shouldn't hold that pricing, right? And so again, acquiring that customer doesn't really do much because next year it's not repeatable. It's not sustainable in the way you acquired them. And so it didn't really create any value. Did you get maybe a little bit of cash flow out of it? Sure, right? It went into your top line, you saw it, maybe it dripped down even into your profit a little bit. But because it's not coming back, it shouldn't be included in the valuation. And something that people don't realize is that, again, valuation is a forward looking thing, right? If I'm buying a business as an investor, I'm looking to future cash flows, not historical cash flows. So I
Right.
almost don't really care what you did in
It's
the
like
past.
the past
Right?
is
I'm
the
looking
past.
exactly what's going to come in the future and how risky is that? Right. And so the more sustainable revenue can be, right, the more that I have long-term contracts, that more that I have repeatability, the more that diversified that pool of revenue is, the more valuable it is to a buyer. So less risk, more value, right? The discount rate is the other side of the coin, cash flows being one, discount rate being the second one. And if we're seeing into the future, and I know that I have to discount those cash flows back to today to pay a price and calculate a price, then I want those future cash flows to carry as little risk as possible.
Right. And so your role also, I just want to, I guess, revisit the adjusted EBITDA, right? Just for the followers and the subscribers. Some are familiar with that, some may not be. EBITDA, you can't add back to it. The one-time cost, you add that back into it. But on the flip side, just bringing this point home, there's also the revenue consequence. If there's one-time revenue, it's the same scenario. One offsets the other, right? I've gone through this exercise actually fairly recent, so I'm very familiar with it. I was hoping to come out the other end more positive, but it didn't work out that way. But part of, I guess, employing an M&A advisor, an investment banker, is to help tell stories around some of that revenue as well, and to build a storyline around, if it is a one time, is it at least a repeatable one time, right? So I think it's important just to state that's what a good team brings to the table. When you're going into M&A, you want a good team behind you, because that's the things they're going to help founders with. Is if you do have a revenue stream that maybe isn't as predictable, it's a one-time cost, one type of transaction. But if you can show line of sight to, I can get a lot of those, that story gets a little more interesting and you get a little more value add for it versus, hey, it was just a complete one-off. We'll never get that again.
That's right.
Yeah. So your role in the whole equation is you probably help with building out a lot of those stories, is I guess the point.
Yeah, I think what I tell founders is, have a story. You're still trying to attract a buyer, and so you have to tell them a story that's positive and that looks forward and that allows for them to create additional value. You don't want to tell them, well, I've done everything there is to be done and this company is perfect, because then what's their role in it? How are they going to add additional value? All they're doing is going to run your perfect company, right? So while that at first sight might seem like the right thing to do, right? My company's perfect, it has no issues. One, if it does have issues, they're going to come bite you in the ass in the end, right? Once you're going through diligence. So that's not great. It's better to be upfront about the skeletons in your closet, or to fix them, right, as you're going through the problem, and acknowledging that you're fixing them. But two, you want to leave a little bit of room for them to improve margins, to perhaps bring in an adjacent market, to do something in the future that allows them to not only purchase you for what you're worth today, but to add value beyond that purchase price, right? They're going to be competing. You already have the winner's curse at play where you're kind of overpaying a little bit. And so you want to make sure that there's opportunities for additional value creation. How do you do that? You do that through a story. Now, what do I tell people when they're telling the story? Back it up, right? So one of the major pitfalls of any company is not having clean financials, right? So everybody knows this. Everybody tells companies, look, if you're thinking about an exit, start cleaning up your financials. Hire a better bookkeeper, hire perhaps an accounting group, do, if not an audit, a review, maybe hire some technical accountants to help you with the complicated stuff, and just get your books in order. The thing that I tell people is, once you have that, make sure you're also building the double clicks. What do I mean by double clicks? If you have a perfect listing of your inventory, right, and I know that it matches to your warehouse and everything's accounted for, that's helpful, but it's not as helpful as you tell me, when was that inventory purchased? How quickly does it turn? Do I have those snapshots of the quarters? Do I have those snapshots on a monthly basis? Do I have those snapshots only on a yearly basis, right? Even that could be better than just showing one listing, because it tells me rotation. It tells me if I have obsolete inventory. It tells me how the prices have changed if I bought it 5 years ago versus 1 year ago, right? So all that information where I can double click, helps that future buyer. And if I'm already thinking ahead and I'm kind of always thinking, okay, I need to build the double click for my customers, right? I want to make sure that I can show people, when did that customer start? How did they evolve? What's my top 10 customers that create revenue? What's my top 10 profitable customers? What's the full list of customers, right? All those double clicks, if you can start adding those into your data room in advance, a buyer is going to thank you tenfold, because they can search for something and they're going to know it's there. And they know that you're managing for value because you're thinking about those things. So that's something that I always tell them: have the story, but back it up with numbers, clean up your financials, but make sure you're building the double clicks as well.
What helps to start set the stage that you're buttoned up and you're deal ready. Those double clicks that you talked about, I guess I can liken it to a board meeting. When I'm in a board meeting, if I don't have those double clicks ready to go, the board's going to eat me alive, right? If I say something on the tip of my tongue and it's like, boom, 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 it's dead. We're done. We don't have to investigate anymore. But the minute they see a slight opening, that door gets kicked down, and now you're in a conversation. Your whole board meeting gets derailed and you're just focused on that, right? And so same thing with diligence. You were talking about skeletons in the closet. One skeleton turns into two, turns into three, because it sends someone down a rabbit hole to do more thorough diligence than what they originally anticipated, right? And they start uncovering more.
That's right. You can ruin trust very, very quickly when somebody finds something. And it may not be like ill-spirited from your end, right? It may not be like even lack of preparation. Sometimes somebody finds something, they're like, hey, I kind of want to learn more about this. You just don't have the financials. You just never track that because it really wasn't part of your business. I think that's an opportunity to convince the person, like, hey, we don't really track it. This is why it's not as important for our operations or whatever it is, right? Just kind of build that story. But if they feel, like you said, hesitation, they feel like you're not so sure about what you're saying, or you haven't really thought about why it is or it isn't important, they're going to start drilling you down and trying to get to the bottom of it. And it can lead to a conversation that was supposed to be 30 minutes, becomes 3 hours, and then they leave and they don't feel good about it, right? And so suddenly the deal may be at risk because of something that is relatively small and that you could have prepped for if you had some additional time and you knew that it was coming, right? So as bankers, sometimes we tell people, call us a couple of years in advance, maybe even start working with someone like me, like a valuation expert, so that you're setting kind of a stake on the ground, right? You're doing this kind of exploration, and then you start at least thinking about, oh, okay, I'm missing these things. I need to work on these things. Oh, I realized that maybe the value wasn't where I thought it was, and now I need to take these future actions, right? So knowing that kind of initial point, 2-3 years before you actually are going to go through a transaction can be really important. And, we talked about fitness, and, I have been going regularly to the gym, have had classes, took weightlifting in college, and I've always felt like I have relatively good form and not trying to hurt myself either. So, I try to maintain good form, but I used to train it this summer, and the trainer can spot things from the outside that I can't see, right? Even if I'm looking into the mirror, I can't really see my squat form where my right leg goes up a little bit faster or goes down a little bit slower, or whatever the case may be. And so we started working on the side muscles. We started working on balance. We started working on things that I typically don't think about. And it's not great, right? When someone's calling you out like, hey, like your legs are not going down in parallel, you're doing something wrong, or hold the weights longer, you're not holding enough on the down. It doesn't feel great, but it makes you better. And by the end of the summer, I really felt like I could do it on my own again. And that's the same with your company, right? The idea isn't that you hire a consultant and that they're forever. It's that they're coming in, they're a little bit more objective than you are. And if you're responsive and you're open to hearing what they have to say, sometimes just by virtue of them being outside of the day-to-day, they can be very valuable in that sense.
And oftentimes it could be just things that that person already knew. It just needed that outside perspective to surface it, because you get so tunnel vision. We're sitting here and our eyes are sitting just above the water, and we just needed someone who's like, well, no, I'm looking completely above the water. And so I'm going to bring this back and resurface it to you. And it might be like, you're right. I remember, what am I doing? Right. Sometimes that happens, but I can relate to the fitness analogy. Unfortunately, I'm not in my best shape right now, so I'll close my jacket up here. But when I was, that small critiques made a huge difference. Having that outside perspective from a personal trainer was game changing. I remember I went to my trainer. I was like, he's like, what are you eating? I'm like, boom, boom. I was so excited about it. I'm like, yeah, we need to change that up. And I was like deflated for a second. I was like, oh man, I thought I was doing so great. So I can relate to the analogy. I'm sure a lot of our subscribers can as well. Fitness and wellness deals at the moment. It seems like it's a high uptick. We're in a generation now where we all care about fitness, health, wellness, even in the food and beverage industry. Just got off a podcast recently with a gentleman there. It's an upticking market. So let's just pivot a little bit. So what do buyers want? And I guess maybe we need to talk about buyers, not collective bundling them all together. There's strategic buyers, there's PE buyers, right? But maybe if we broke them out, what are they looking for from growth and EBITDA right now? I know we covered a little bit of that early on, but maybe we could just dive a little deeper into that. What are you seeing from a trend perspective, if any?
Sure. So what I will tell you, what they don't want to be is they don't want to be your consultant, right? So they want to know that you thought about things beforehand. They don't want to be the ones that are telling you, hey, why don't you do this? How come you haven't done this? Right? They don't want to play that role. They want to come in and see a certain level of maturity and sophistication in your business that you've been thinking for a couple of years. A lot of the time, they want to see process and they want to see the potential for scalability, right? So, for example, if you're a small business and you're only in Los Angeles or you're only in San Diego or whatever other city, but you can prove that that model is replicable, right? So, let's say you start in San Diego and now you're doing it in Los Angeles and it seems to work, and you're testing in Seattle and it seems to also work. That's a great test for a buyer because they can come in and see the scalability potential of your business. That's one thing that everybody wants to see. They want to see that your business is scalable, not just that it can grow, right? But that it can scale, meaning that it can grow beyond the next level of input. What I mean by that is if I invest one and I get three, right? And the next time I invest one and I again get three, and the next time I again get three, that's growth, right? But if I can invest one and get three, and the next time invest one and get 3.3, and the next time invest one and get 3.6, and et cetera, right? I'm showcasing scalability. That's incredible for a buyer. The other is the one we spoke about, right? Sustainability in revenue and reduced risk of revenue. So not having too much of concentration of customers, not having too much concentration in your suppliers, right? Like now we saw with tariffs, the people who had suppliers in Portugal and Turkey and South America and China were way more protected than the ones that were solely supplying from China, right? You already thought about the diversification of your supply chains, and that's incredibly valuable as well to a buyer. Another one is predictability. And so if you have contracts and you have long-term contracts, that's fantastic. If you, on top of that, have already, for example, thought about how to lock in those customers beyond just a contract, right? Because let's just say that they're customers of another product that you have, and turns out that those products link up, or they take three services from you, not just one, you know that those relationships are stickier, right? So that's what buyers are also looking. Is it a contractually sticky relationship, or are there at least moats and things that you can point to that showcase that it's a sticky relationship regardless of contracts? There's some of the things that buyers are looking for. And like we said, right, just having things organized, being able to double click and understand what's going on in your business, seeing that you have a process behind things, right? Like the last thing you want to do when you have an employee is they come in and they ask, well, okay, like where's the training? Where's the onboarding? And you tell them like, no, you're just thrown into the water and you got to know how to swim. That's very difficult as an employee, right? But if you tell that to a buyer, they kind of know that there's no process in place, that there's no documentation, that there's nothing truly built. There's a saying, and I've kind of said it before, I don't know if it's exactly correct, but that 80% of businesses fail, right? Eventually, running a business is pretty difficult and new ideas are difficult to execute, but 80% of franchises succeed. So it's a complete inverse, right? I don't know if those are the perfect stats, but the reason being that one, it's been tested, right? So there's been other franchises, or there's at least been multiple locations by that franchise. And two, because they're very strict on process and documentation. So they can showcase that, again, it's a repeatable process that has success, that works. And it's across their operations, it's across their sales, it's across their investment in R&D. And so by having that repeatable process, again, you kind of showcase that the business can continue to grow and can almost continue to grow in more of an automated kind of fashion.
Makes a lot of sense. So just to dissect a couple points that you brought up. One of them, which is they want predictable revenue, right? The revenue that has some commitment behind it. What I find with a lot of SaaS startups, tech companies, especially more as you start to mature, they're still very focused on logos. That's okay early on. You want to just focus on logos, getting brand awareness, those things. But there comes a point of maturity where it isn't always just about logos. You got to start incentivizing your sales team differently, right? You got to incentivize your sales team. How do we get strategic accounts? How do we get accounts that are going to grow and scale? How are we going to incentivize the sales rep instead of on the new logo? Maybe we incentivize on the commitment of the customer. Is it a 2-year, 3-year, 4-year, 5-year, right? And what I found from my own personal experience, when you do that, guess what? You end up with a lot of 3-year, 4-year deals, which becomes a lot more attractive. That's what PE firms want to see when they're investing in businesses. And they want to see it, and to your point, I've seen the same. It's the operational efficiency, the processes, and they don't need to know that you can scale into everywhere. And they just need to know that you know how to scale and you know where you need to scale to. That's a bankable business to go and invest in, right?
Yeah, and it doesn't mean that you have to completely reinvent the wheel, right? There are all already systems out there like the entrepreneurial organization system, which is one we use, that just adds a bit more clarity into your processes and a bit more structure into your processes, right? So it helps in just having a cadence of meetings, right? Same page meetings, understanding where the firm is, dealing with issues. How do you deal with them? Do you deal with them on a weekly basis, on a monthly basis? How often? What types of issues come up, right? You keeping a record of all of that. And so, again, if I can see the history of a company and understand why they went through some ups and downs, I can get more and more comfortable that it's okay that I'm going to have some additional ups and downs because there's usually an end in sight. And so that I think is a good way to run your business with the eye that you could sell it at any minute, right? If you have that, maybe pressure is not the right word, but you have that guiding compass that you could potentially sell your business, you probably will be a lot more intentional in how you phrase things and how you document things and how you hire employees and how you treat them and how you onboard them and how you run your sales process as well.
Yeah, I think that's something just to stress to the listeners. Stay deal ready. Don't wait for someone to knock on your door. I say it all the time on this podcast. Don't wait till someone's knocking on your door to go get your ducks in a row. Get ahead of it. Go talk to Jordi. Talk to him a year or two in advance. Start organizing your data room, getting your documents organized, building your business, documenting it. Unfortunately, to your point, you're bringing up the documentation. That often gets pushed to the side. We're challenged with it right now as a company. I just actually had this conversation with my team and my leadership team. We got to get better about documenting things. Document how our architecture is structured. Document all the processes for security. Like document, it's so important to document how things are done. It can't just be up here because if I go get hit by a bus, guess what? It's only up here, right? So I can relate to that significantly. So let's go ahead and shift gears a bit just for sake of time. Well, we're going to talk about valuation, which I think that was a good segue into that, treating valuation like a dashboard metric, right? So I think the segue I'm referring to is always be deal ready and always having that in mind. Same thing with valuation. That should be a metric for the business that probably changes how you operate. Can you speak to that a little bit? Because that's something I know in our conversation you brought up.
Sure. So if you wanted to sell your house and the pictures you took was when your house was a complete disaster and it's messy and there's stuff everywhere and the kids' toys are all over the place, a buyer's maybe not going to see it in the best light, right? And so you always want to showcase to the best of your ability. And then in the final rounds, sure, maybe clean it up a little bit more and put some dressing on the windows to make it look nice. So valuation, what I think allows you to do is two things. One, really examine your history to understand what has happened, right? How did we get to where we are today? And if you have a partner or you have other people working in the firm, do they agree with what happened, right? So it may be that we look at your historical financials. It may be that we look at management documents, your process, et cetera, but we understand how you got there, right? So it forces you to kind of analyze and revisit the history of your business. The second thing it does is it forces you to create a forecast. A lot of the time when you're doing valuation, you want to do some type of income approach, or you want to do some type of future approach, so that again, you start thinking about how a buyer is going to look at your business. And putting things on paper can be a really great exercise. When you have somebody also helping, you can be even better. And so what I tell people is, now that you've agreed on the past, can we agree on the future, right? Do other people in the firm also think that you can achieve the forecast that you think you're going to achieve in 5 years? Is it reasonable? Does the market support it, right? So you start asking a lot of questions that maybe you haven't been so attuned to, because you're dealing with the day-to-day firefighting, and you're dealing with the day-to-day of sales and operations and everything else, right? So you take a step back, you think about the history, you think about the future, and by doing that exercise, you set that stake in the ground of, okay, now I know where I'm headed, right? Now that's your guiding blueprint for what's coming in the future. And it may be that you realize, actually, I don't think I can meet this forecast, right? It's not really possible with the workforce that I have, and to hire 2 more people, it's going to cost X amount of money, or we're low on cash right now because we're coming off this difficult year, right? You start having a lot of those conversations either with yourself or with your partners that make you realize where you are and where you're going. So if you're doing that a few years in advance of a potential sale, any type of transaction, you're running a process that already gets you thinking about value creation. It's fine to just see where you are, right? Like, what value have we created up to this point? But then it also helps you think about, what are the levers that I need to think about to create additional value? And it may be that you're already saturated on your margin. We had a transaction in which everybody was really excited about the company, but the only way to grow value in that company was through top line, because they were completely maxed out on the margin. They were already incredibly well priced. They had done everything in terms of operations, right? Really clean company, really well run. And so if you think that you're going to come in and your specialty is turnarounds, or your specialty is, expanding value, reducing costs, that was not the type of company. It was going to be a sales play. And we didn't realize it until we put it on paper, right? We saw the valuation, we started stress testing. You could only get maybe a point or two, because the comps were also kind of showcasing that you were maxed out on sustainable margin. And so by, again, running that exercise, we realized, okay, it's a sales play. And is this the best company to perform that sales play? And it turned out that they weren't, right? It was not the type of company that was willing to risk a lot. It was not the type of company that had a huge sales force that could grow upsell or cross-sell or anything else. And so they decided to pass on the transaction. But until we put it on paper, we didn't know that. You can run the same exercise, right? How would a buyer look at my business? And you can do that through valuation, and then do it again next year and the year after that. And you can now really see, are the actions that I'm taking creating value?
Right, right. Listen, we could dive into this topic at length. Unfortunately, we're at the tail end of time. I want to make sure we talk about you for a split second here and dive into a couple other quick items. But let's start with, as far as you and what you're doing, what's your why? Like, I guess, why are you doing this? What's behind it, right?
So, there's some people that you put a puzzle in front of them and they can't sleep until they solve it. I have a little bit of that mindset, but for me, it's always been, okay, here's a business. What's good about it? What's bad about it? Let's dissect it. I've always loved that idea, maybe because I'm a little bit more risk averse myself. So it's a little bit easier to do it from a critical standpoint than really go out and do it yourself. But, it's always been a beautiful challenge, I think, to try and uncover what's really valuable about people, about things, about businesses, about assets, and then understand how to grow value from there, right? Since I've been a kid, it's always fascinated, like, why is this watch way more valuable than this other watch? Is it just purely the brand? Is it bragging right? Is there like the ability to sell that into the future? Like, why is something valuable to people? And the answer is never perfect. So it's been kind of this quest and this search to try to uncover what really drives value, what motivates people, because ultimately value comes from the way people see things. And it's a really beautiful mix of economics and psychology, which kind of was my undergraduate major minor combination.
Makes a lot of sense. I mean, curiosity is one of the number one traits I look for in anybody I hire. I want people who ask the questions, why, right, on a constant basis. And it sounds like you're one of those individuals, since you were young, who is just genuinely curious, what makes the watch tick, why one watch versus the other watch. So it's a good quality to have. Well, this is great. Let's shift. again, gears one more time. And let's just talk about how do people get in touch with you and why should they get in touch with you? And I think you hit on it already, but when should they get in touch with you?
Sure, absolutely. So the best way to reach me typically is through my email. So it's Jordi.Pujol, Pujol at Objective IBV. That's Objective Investment Banking and Valuation.com. And you can definitely reach me through the company webpage. You can reach out to me through LinkedIn. Any of those avenues, I'm constantly checking, making sure that I'm attentive to folks. And you can also follow my newsletter. It's on LinkedIn. I post often about different things about business, value growth, value creation, value measurement. And so you can find all of those on my LinkedIn profile as well. Our website is really easy, objectiveibv.com, and you can find the rest of the team there. There's folks that specialize in certain industries and that truly specialize on sell-side M&A and the full sell-side process. And there's folks like me that specialize on the valuation and a more technical financial modeling type exercise.
There you have it. I know our connection came through LinkedIn, and one of the things that attracted me to having you on this podcast was the posts that you have. I look into that type of stuff to make sure it's going to resonate with the audience. So it's been a pleasure having you on the podcast. There's so much we didn't unpack. At some point, I'm sure you and I are going to regroup, come up with how can we dive deeper into all four of these topics. So I do look forward to having you come back onto the podcast show at some point. With that being said, I appreciate all your time. That's a wrap for another episode of This Is M&A. I look forward to seeing everyone on the next one. Until then, stay sharp, stay deal ready.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This Is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.